Jerome Powell, chairman of the Federal Reserve and the man who has overseen the Fed create more than $6 trillion out of thin air in just the last 2 years. J-Pow, as he is best known on the interwebs, has reached celebrity status with dozens of memes highlighting his ability to fire up the money printers. To put that staggering number into context, in just the 20 seconds you have been watching this video so far, Jerome Powell and the Fed would have created $2 million at their current money printing rates. We have seen the government and media narrative on inflation slowly evolve this year, as prices on shelves, at the pumps, and in our supermarkets have rapidly increased. What started as "there is no inflation" became calls that inflation is transitory and a supply chain issue, to inflation is here to stay, and even so far as why inflation is good for us. Now, in the first few weeks of January 2022, all eyes are on the Fed as they plan out interest rate hikes throughout the year in attempts to gain back control over inflation. In the last 2 years, the U.S. Federal Reserve has increased the money supply by more than 37% to pay for the American Rescue Plan, the CARES Act, and other pandemic relief and spending programs. The U.S. federal debt set a new all-time high of $28.5 trillion and eclipsed all past records at 125% of our GDP. There is no such thing as a free lunch. Only the Costco hot dog has managed to weather the storm so far, and inflation has finally caught up with us. The official numbers as of November came in with inflation at a 6.8% yearly increase. After passing the largest spending bills in the history of the US government in the last 2 years, some politicians are attempting to now blame the inflation we are seeing on greedy corporations. Is it really the grocery stores, the ones who have stayed open throughout the pandemic and dealt with massive disruptions so we have access to food, the ones to blame for the surge in prices across all categories of our economy? Inflation is a highly regressive tax. It affects those without money the most. And in many countries outside of the United States, inflation is ever present, as 1.1 billion people live in countries with double-digit inflation rates. We all use money on a daily basis, but we often never step back to look at the processes by which it originates. And there is so much that goes on behind the scenes that drives everything from the prices at our local grocery store to our rent and mortgage rates. So what is inflation? How does money get created? And how are we all affected? In part 2 of this video series on money, we'll break down and explore how the Federal Reserve creates money. We'll look at aggregate numbers of how much money there is, review inflation and how it happens, and we'll look at monetary policy and tools of the Federal Reserve. Be sure to stick around for the end of the video, as we'll circle back to current events so we can all answer for ourselves. Who is to blame for inflation? We have a lot of exciting things to cover in this video, so hit that subscribe button below and let's dive in.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally. And we do that by buying treasury bills or bonds or other government guaranteed securities. And that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve Bank.
In part 1 of this video series, linked below, we saw examples of how money works in a basic economy with metrics like GDP, money supply, and velocity of money. This is helpful to see transactions and concepts in individuality, but a fixed supply of money is not how the world works. The United States abandoned gold conversion in 1971, and our monetary system is now purely a fiat system, meaning our money has no backing by any asset or commodity. Every modern country operates on this same fiat system, many with their own central banks that carry out all fiscal policy. We'll focus on the US Federal Reserve in this video, but the concepts apply broadly across the world. The Fed was established in 1913 and has chartered goals of maximizing employment and keeping consistent low inflation. The Fed operates independently from the government, and I say that with quotes, as it operates under the oversight of 7 governors, who are all appointed by the president and confirmed by a majority of senators. Jerome Powell was nominated to the Fed board during the Obama administration, appointed as chair and approved during the Trump administration, and then appointed for a second term and awaiting Senate confirmation under the Biden administration. The Fed operates 12 member banks who are responsible for overseeing operations in their various regions. So banks like JP Morgan Chase or Bank of America will abide by all regulations and charters enforced by the Fed and its regional banks. Let's take a step back and quickly look at the two ways our government raises money for operations. First is collecting taxes. Although complex in detail, we understand the concept that if the government raises or introduces new taxes, it will collect more money. This can be any combination of personal income tax, corporate income tax, capital gains, etc. The government can also raise money by issuing debt. Just like the tailor in our last video, the government can take on loans, which it does with three types of debt instruments: treasury bills, treasury notes, and treasury bonds. All three of these are similar. The difference is the term length of the debt, anywhere from 1 month up and through 30 years, and how the interest payments are structured. Every week, the government holds auctions, open to the public, where banks, corporations, and other countries will purchase the various forms of debt issued by the federal government. The interest rate on this debt is determined by the free market and can be seen on many public sites. All of this government debt is essential for its continued operations. The last time we had a balanced budget and covered all operations purely through tax revenues was in 2001. Our government is completely reliant on debt to finance current and future expenditures. So this begs the question, why is anyone buying this debt? You wouldn't invest money in a business that hadn't had a balanced budget in 20 years, would you? The United States has never defaulted on its debt, so other nations and investors continue to hold it with high confidence. But everyone also knows that we have the ability to print money to repay our debt, which brings us to the first form of how money is created. So how exactly does J-POW fire up the printers? Yes, the government prints new bills and creates new coins, and this accounts for some 3 to 8% of new money issuance. But the vast majority of money is literally created with the click of a button at the Fed. The Fed will purchase government debt, and a journal entry will add the government bonds to the Fed's balance sheet and cash to the government's balance sheet, along with a liability of an IOU to the Fed. For example, when the government passed the CARES Act and American Rescue Plan bills for COVID relief, the government issued debt that was in turn purchased by the Federal Reserve. This money came from nowhere. It was created out of thin air by the Federal Reserve and given to the government, and eventually distributed under the terms of the bill. This process is called quantitative easing, a complicated sounding term and process to cover up what it really is, which is creating money out of thin air. The graph here is the Federal Reserve's balance sheet. We can see that in 2020 and 21, its assets grew by $4.5 trillion as it bought government debt. And on the flip side, we see the government debt, which is the amount the government owes to the Fed, corporations, and other countries, increased by about the same. Now you might be wondering at this point, if the Fed can just print money out of thin air, does this devalue all existing money? The answer is absolutely, and we'll cover inflation shortly. Another way the Fed creates money is through setting a rule known as the reserve requirement. As part of its operations, the Fed oversees all banks and credit institutions and is able to set and change the ratio of how much its loans a bank must keep with the Fed. This reserve ratio ends up being a money multiplier and allows for commercial banks to create credit, which is all new money in the system. This process is known as fractional reserve banking and is prevalent throughout the world. Fractional reserve banking is a complex topic, so let's walk through a simplified example. Let's say the Fed sets the reserve ratio at 10%. At this rate, a bank must keep 10% of their cash on hand with the Fed. However, the remaining 90% they can loan out to other individuals and corporations with the intent to make a profit through interest on the loans. If the bank only keeps the required reserve of 10% or $100 on reserve, they create new money in the system of 10 times that amount. So how does this work? Let's say Alice decides to deposit $1,000 at Bank 1. We have the bookkeeping like below. The bank has assets of $1,000 and a liability IOU to Alice, and Alice has an asset of $1,000, which represents the IOU from the bank. Now that the bank has this cash, it won't just let that money sit. It will put it to work. And along comes Bob the farmer who needs a loan for a new tractor. So the bank keeps 10% as reserve, which is required by the Fed, and it loans the remainder, or $900, to Bob for new equipment. Now we can see everyone's balances. With his new loan, Bob the farmer heads over to John Deere and buys a tractor. What was an asset of equipment for John Deere is exchanged for an asset of cash now on their books. The John Deere company, now with this excess cash and equipment sale to Bob, decides to deposit its money into its bank, which is bank number 2. And now bank number 2 has $900 and will loan out $810, keeping the 10% or $90 reserve on its books for this loan as this process continues. This will continue on until all of the money, except the reserve amounts, have been loaned out. Eventually, in this example, we will have $9,000 in loans and $1,000 in reserves, for a total of $10,000 in money, which is 10 times what the Fed created originally. And this is how banks create money in the system. Bob has a new tractor, and Alice and John Deere still have money in their accounts in the form of IOUs from their banks. If we chain this process together, the reserve requirement and money multiplier can be used to determine fiscal policy impacts from the Fed. It is worth briefly noting that during COVID, the Fed set this reserve requirement at 0% and has yet to increase it, which effectively turns over the role of fiat money creation to commercial entities, which are the same banks who caused the financial crisis of 2008. If a bank can find a way to deploy capital with any sort of real return, it can simply create new money in the form of credit in the markets.
Dr. Berry, these should be fine.
Yeah, we're prepared to sell you $5 million in credit default swaps on these mortgage bonds.
Can we make it 100 million?
Absolutely, we can make it 100 million.
To quickly recap the last section, the government raises money through taxes and issuing debt, and the Federal Reserve can create new money by purchasing government debt and thereby digitally printing money, or lowering the reserve requirement for banks. How do we measure and track how much money is in the system? The Federal Reserve keeps statistics on overall money supply broken out by different types of money. The first type of money is M0, also known as the monetary base, which refers to central bank reserves and all of the physical paper and coins in circulation. M1 includes all of M0, plus the amount of demand deposits, travelers' checks, and other checking deposits, including most savings accounts. And M2 includes all of M1 and M0, plus money market accounts and small certificates of deposit. M2 is the broadest definition of money, as it includes all other types and would cover all of the money in our earlier example with Alice and Bob. The stats for all of this money are published by the Fed. We can see that between January 2020 and November 2021, we saw our M2 money supply increase from $15.5 trillion to over $21 trillion, a whopping 37% increase in less than 2 years. But what about stocks, real estate, and crypto? Where are they included in the money supply? There are many unofficial calculations for how much money is in the system. But for assets such as stocks and real estate, they are not included in any government official definition. For example, if you have $1,000 in your checking account and move it to E-Trade to purchase a stock, this money is eventually transferred to the seller of that stock, who then presumably moves the money back into another checking account. So no money is created or lost in the purchase or sale of a security in this example. Crypto may eventually play a different role in this, but that is for another analysis and video.
We are not broke as a nation. We are not bankrupt. We can't go bankrupt. We absolutely cannot go bankrupt because we have the power to create as much money as we need to spend to serve the American people.
That video clip is from active Congressman John Yarmouth, who currently serves as chair of the House Budget Committee, and it is quite shocking to say the least. If we can just print any amount of money, why even bother paying taxes? Why don't we go ahead and give everyone $1 million? This is a Zimbabwe $100 trillion bill. Today that bill is worth less than a single cent after the Zimbabwe bank rapidly increased the money supply, and it serves as a stark reminder of what can happen when any nation prints too much money. Inflation occurs when more money is chasing the same amount of goods or output. Back in the part 1 video, if overnight we gave everyone in our simple society an extra 250 gold coins and doubled the money supply, we would expect that the cost of goods and other assets would quickly rise by that same factor. The government tracks monthly inflation rates by aggregating price data across a wide variety of goods and locations into what is known as the Consumer Price Index. Items are given weights of their importance and value, and in this way the government can see if a gallon of milk increases across the nation. Taking a look at the November 2021 report, we see an overall annual inflation increase of 6.8% across all categories. When inflation occurs, people holding debt are actually the ones who benefit. If you take out a loan or mortgage for $1,000 and have to pay it back next year at 10%, then inflation helps you, as the next year the amount to be repaid is worth less. And who did we see has $28.5 trillion in debt? Ah yes, that would be the government. Likewise, asset holders, those with real estate, stock, and other commodities, will presumably be the same next year. Real estate will rise in value, and companies will increase revenues to offset their inflated increase in expenses. Anyone holding cash, however, loses purchasing power every year with inflation, and anyone without assets also loses as the money they make does not go as far. The dollar loaf of bread now costs $1.10. This is where inflation becomes incredibly regressive. A 20% increase in the price of groceries may not be so bad for someone whose assets have also increased 20%. But more than 50% of Americans live paycheck to paycheck, and this is a massive new invisible tax effectively put in place by the government. So if inflation reduces purchasing power and is especially regressive towards those with little or no assets, how does the Fed ensure we don't have runaway inflation? The first and most obvious answer would be to not put more money into circulation. Taken one step further, the Fed can actually reduce the money in circulation by selling government debt into the public market. This takes money out of circulation and puts it back on the Fed's balance sheet as an asset or cash. The second option is to increase the banking reserve requirement to reduce the money multiplier effect we saw earlier. One other very important and followed metric is known as the federal funds rate. The Fed sets and pays an interest rate to its member banks for any amounts they keep deposited with the Fed. So when the Wall Street Journal or others talk about the Fed increasing the interest rate, this is what they refer to. And this interest rate has broad implications for everything from mortgages to business loans. If a bank can receive a 3% interest rate on any balance they keep with the Fed, then the bank will require at least that much of a return when they loan it out. No bank is going to give a 2% interest rate mortgage when the Fed is paying them a higher rate to keep their money parked. All of these tools that the Fed uses to manage the money supply and try and ensure we don't have high inflation or unemployment are referred to as open market operations, and the Fed meets every 6 weeks to review interest rates and enact any policy changes. To recap so far, we have seen how the government creates money through digital printing and changing the banking reserve requirement. We have seen how we quantify the supply of money in the system, and we have reviewed inflation and the tools the Fed has to control it. Right now, we are at one of the most interesting points in history. Never before in the Fed's history have we seen a zero reserve ratio, a zero federal funds rate, massive free money creation, and high inflation all at once like this. It will be interesting to see what happens in 2022. The Fed has already indicated they will be raising the federal funds rate throughout the year. The S&P 500 is up some 40% since the start of 2020, which is roughly in line with the increase in money supply over that same time. While PE multiples may be trending higher, this may also be that the largest tech companies make up 40% plus of the index, and exponential change in technology is becoming a norm. And it is also worth noting that technology is a deflationary force. As more of our world moves to the internet, technology may be the driver to counteract current inflation. To circle back to the claim that corporations are being greedy and gouging consumers at the grocery store or at the gas pumps. With a 37% increase in the money supply and early stages of inflation at 6.8% across all aggregated categories of the economy, it may be time for politicians to revisit the narrative and impacts of their own spending and policy. To demonize the same corporations that have jumped through hoops and lockdowns throughout the last 2 years to keep their businesses running and provide us with energy, electricity, food, and shelter does not appear to be a good look. The Fed prints the money, the Senate approves the Fed members, and the government has been proposing and passing trillion-dollar bills. The first rule of economics is scarcity, and many politicians seem to disregard this lately. The Office of the Inspector General estimates with reference to the CARES Act alone, quote, by program end, $87.3 billion in unemployment insurance benefits could be paid improperly, with a significant portion attributable to fraud. Offering unemployment insurance to everyone is a good use of spending, in my opinion. But with $87 billion in estimated fraud that is worth more than the entire market cap of Lehman Brothers before the 2008 crash, it may be worth investigating before we throw the blame of our economy to the grocery stores. What are your thoughts on inflation and our current monetary policy? Please add your insights to the comments section below. Money is complicated, and there is so much history and politics involved. But hopefully this basic look into understanding some of the rules of the current game offers insight to help appreciate the good and the bad of the current system as new technologies and innovation come along. and the idea of having a decentralized store of value that cannot be changed by the government is already becoming one of the most important check and balance mechanisms our society has. As always, thanks for watching, and please hit the like button and subscribe if this has been helpful. See you in the next video.